With U.S. markets setting new all-time highs, the bear market of 2 years ago feels like a distant memory. So why am I talking about the summer of 2022? Well, this is our 500th episode of Money Talk Live today, and we're joined by our guest from Show One, Vitali Mossounov, VP Director and co-lead for fundamental equity research at TD Asset Management. So glad you could join us for this. Of course, you were the inaugural guest.
Well, it's an honor you'd consider having me back. I really do appreciate it. I'll never forget that first episode because it was about 2 years ago, right, Greg? And I had my phone right here on the table. And I don't know if you were too happy about that or if your producer was, but I was expecting a child. My wife was due any day, and I had to keep that phone on, family first, as they say. And I was just thinking back, preparing for the show, reflecting, I've changed a lot. Being a parent of two now, you can't help but change and grow. But the market's attitudes probably have changed even more. When I was looking at the levels of the S&P back in late June 2022 compared to today, it's been a complete 180. So changes all around us. I think it's the latter portion that we're probably going to focus on today, not my family.
But it was an interesting show. The only thing that got me curious is like, oh no, he's going to become a new parent, and then he's such a great guest. He's not going to be available all the time because I know what it's like to be.
I'm still here for you, and even with two kids.
But you are still here even with two kids now. But as you talk about, we go back, we look at that first show. We're in a bear market. No one's feeling good about the market at all.
Yeah.
People are concerned about inflation. Interest rates are on the rise, and now we come to today, and we've seen a big run in the S&P 500, about 50%. Like, what happened between then and now?
Yeah, and you go back and look and watch that first show, and I really like the messages that we had because the first and foremost message was, look, panic has set in. That was really the summer of 22. Panic had set in, and panic we defined that this obsession, this compulsion with the short term. We couldn't see any further than the near-term headwinds. And at the same time, well, guess what? The market, it understands all of that. The market is discounting the future. And by then, Jamie Dimon had come out and said there's a hurricane just days before the show. By then, inflation was already staring everybody in the face, that vicious specter of inflation. So the reality, as it turned out, it was much more benign, right? No deep recession, no mild recession, actually, and a lot of good things, including inflation rolling over. So everything passes. Investors forget to remind themselves of that when they are in panic mode. And that's why again and again, not just me, but a lot of our guests remind those watching, please focus on your process, focus on your investment objectives, time horizons. And if you're anything like us, and you don't have to be, but if you're anything like us, please do focus on quality businesses.
Well, let's talk about quality then. As we talk about that, and we hear that a lot, what do we mean by that? How do we put that into practice?
It's a bit of a tricky word, right? You hear it a lot, quality,
yeah.
quality, and what am I really buying here? Look, we think of it pretty simply. It's the predictability and sustainability of earnings, that earnings stream. What are you getting? Is it going to be volatile? And is it going to last far out into the future? Can it grow? The growth potential of that stream of earnings? And finally, what are you paying for? The so-called valuations. To me, simplistically, that encapsulates quality, right? And I want to demonstrate through a very simple chart. This is a composite I made of the big tech names, the Amazons, the Googles, the Apples. I think the audience knows what we're talking about here. And that's the green line there, that's their price. That's a little composite of their price. And then the orange line is their earnings, right? Now, what do you see there where we have the gray box? Of course, that was that abyss that we were crossing during the first show as it went to broadcast, right? Prices falling, investors panicking, and unlike when you go to a store and see a TV on sale or anything on sale and say, I want to buy it, well, when all these great companies went on sales, everybody started saying all of a sudden, hold on, I don't want anything to do with that. But here's where the quality kicks in, why we should have the confidence to buy. It's that orange line. That's the stream of earnings of these businesses. And you can see as much as the investors, the speculators first and foremost, ran for the hills, abandoned these stocks, the strength of that earnings stream of those companies stopped growing for a little bit, but you could see it stayed about flat. And then the businesses, being led by great management teams and having great products, being in the right industries, made tweaks and changes. And before you know it, we're off to the races again.
Such an interesting chart, too, because we think about what we went through in 2022. You said the panic, people not wanting to own this space. In 2023, suddenly it becomes the outperformer and starts powering the U.S. markets to all-time highs and brings us to where we are now in terms of people saying, okay, we do have markets, particularly south of the border, setting new record highs. What happens next? I think, and naturally, people get a little nervous. Are we due for a pullback, or can we continue to run in this bull market?
Yeah, and every day you now see a headline from a strategist that a pullback is inevitable or highly likely. And Of course, pullbacks will happen. And I think that the 5% pullback probability in any given year on the S&P, 95%. A 10% pullback probability in any given year, 67%, right? So that's the ebb and flow of the market. We can't become dominated by that kind of thinking. I think what's more important is evaluating as we turn up and the market heads higher, what will be signals, and are those signals flashing at us today that we need to be extremely careful about putting new dollars to work. And simplistically, again, I want to keep it simple guy. Think of this in 3 buckets. One is valuation. Valuations are not cheap. They're actually on the richer side. The S&P is around 20 times earnings. The Nasdaq's in the high 20s. That's in the upper range of what you've paid historically. So I'd say a bit of a yellow flag, but not something that's telling you to sell the market so long as the fundamentals are there. Second is sentiment. Sentiment is so important because every time you look back at a bubble, you realize that sentiment was off the charts. Investors were behaving irrationally. Sentiment in 2021, for example, the SaaS bubble, paying 20, 30, 40 times sales for businesses that didn't have earnings. Those companies still down 80%. Investors have not come back to them. We've seen Bitcoin acting weak, down 20, 30% from its peak. And in general, despite the generals of the market behaving very well, I would say that the speculative parts of the market, investors have not gravitated to that. And that's encouraging for me as well. We are focusing as a market right now on quality. That's a good thing. And then finally, market structure. This is a kind of a funny one again. What do you mean, Vitali, market structure? But historically, I really think that the companies that led the market concentration was very different from today. Today's market concentration in a handful of companies reflects the concentration of the actual economy. All the dollars flowing to these businesses and the new modes of intangible technology-based businesses that are so much harder to disrupt than the tangible people-based businesses of the past. And I think that's something we can unpack on a future show. But I think the takeaway for me is I'm not heading into the second half of the year right now worried about the market.
All right, talking about future shows, get out the crystal ball here. Yep. This is episode 500. Where might we be 500 episodes from now? And please don't say that you will be talking to an AI Greg Bonnell.
Well, no, but you might be talking to an AI Vitali.
Oh, no, no, I never have it, never have it.
We'll try to keep this human and real. Well, let me give you a couple of market statistics about corrections. Let me put it another way. Since 1929, over a 2-year period of staying investing, and I'm assuming 500 episodes, you'll have me again, it's about 720 days, 2 years, you've got a 75% probability of being up in the market, right? That's your base rate with 100 years of data, right? So, I could try to pretend to pull out a crystal ball, but to me, it's what's your time horizon and time objectives? If you're in that 2-year plus range, you need to ask yourself questions, as we talked about, are there red flags there about valuation and whatnot? If they're not, the probabilities of being up in the market are on your side. Time horizons are important. It's a competitive advantage for those that have them. And then, of course, going back to what I talked about, quality. I think if you tie that time horizon to quality, and especially if you can dedicate the time for it, and if you can't dedicate the time for it because you're a professional in another field and have other hobbies, finding the right professional that will do that for you, that to me is the not-so-secret secret of long-term success in investing.